don't believe the bullshit about like democratizing access to the private markets. Like that's what you're going to hear all these people say, right? Like we are doing a public service here. It's like, no, they need and they want your money. Right? Like that's what it comes down to, right? And so like the reason that they're going after retail investors now is because they need you. Right. And so and what I've just mentioned is the big reason why they need you. And so this isn't like by accident that it's happening now. And it isn't by accident that you hear right now kind of talk in Washington, talk on Wall Street about like being able to invest part of your 401k in private assets. Welcome to Market Outsiders. It's Wednesday, October 8th. We're excited today to dive into the ultimate market outsider topic, private investing. Before we get there, if you have not yet rated, reviewed, or subscribed the podcast, please go ahead and do that now on Spotify, Apple Podcasts, or wherever you listen. We crave your ratings, your reviews, your honest feedback. And almost every single episode that we do here at Market Outsiders is based on some kind of listener feedback or request. So go ahead and take 5 seconds, do that now. While you're rating, reviewing, subscribing, I'll welcome in my co-host and colleague, Jenny Rae. Jenny Rae, how are you?
Hi, Namaan. Good morning. I think it's almost our 6-month anniversary. And like you mentioned, the ratings and reviews, people have given us such great feedback to help to shape what we do here. And I'm really excited about the conversation today. This is not something that I think about on a morning, afternoon, or evening kind of regularly, but it's kind of one of those things that shapes the big arcs. Like one of my favorite quotes is by Bill Gates. It says, you underestimate what you can do, or you overestimate what you can do in a year and underestimate what you can do in a decade. And I think about private investing in my life and how much that's been true. Like you overestimate how much the daily small decisions will make a big difference, and you underestimate how much a few cornerstone big decisions are going to mean for you. And so I'm really excited just to kind of dive into the conversation today. I also love what like our outfit situation for anybody who's watching on video today. Namaan's got casual covered. I've got business covered. I feel like this is like the definition of a business casual podcast today. Namaan, what do you think?
I'm happy to be carrying the casual half of that business casual motif.
Hey, I think we should every once in a while you should let me switch, okay? So just be nice about that. Like we're talking about something today that I think is appropriate in the business casual space, because depending on where you are in the country, the way that you dress might signify social status in different ways. I've never learned this more than living in California. Nobody with money dresses like, you know, what I'm wearing this morning on the call today. The further down you're dressed, the more casual you are, the more likely your net worth is pretty high in California. And so I had to learn that coming from the East Coast originally over to the West Coast. There's a kind of like a code, a flex code, and the more business dress you wear, the lower down the totem pole you definitely are. But I just wanted to kind of tie in today article that I was reading, Namaan, and I started reading it partially because I wanted to understand what the terms were inside it. I actually wasn't sure that they were talking about the retail revolution, and I wasn't sure whether they were talking about e-commerce and some kind of retail revolution that I kind of didn't know might be happening. I had a little bit of a suspicion because of the name of the firm and the title that they were talking about retail investing, but I didn't really know what kind of revolution we were talking about. And anytime there's a revolution happening and you don't know about it, that's kind of not good for you, right? So you need to figure out what kind of revolution is in play here. So I'm going to just pull up the article. This is an article on Ares, and the title was this: How Ares is Capitalizing on the Retail Revolution and Alternative Assets. So, Namaan, can you just walk us through a couple of the definitions of retail? And you can feel free to poke fun at me a little bit because I read this early in the morning, so I don't give myself 100% brainwave credit. But yeah, when I'm thinking through the retail revolution and what is retail, let's just define terms to kick off and get started as we're talking about what they're seeing here.
Yeah, here's my definition of retail investors. It's your everyday individual investors. And by extension, it's the ecosystem that serves everyday individual investors. So I think a part of a firm like Ares capitalizing on the retail revolution could mean that they're also creating products or financial advisors who serve individual investors. But we're talking about non-institutional investors, which means not hedge funds. That would be my very broad definition of retail investing.
Yeah. And I would expand maybe the institutional group to, right, even private
True.
foundations
True.
or, private or university foundations, which are basically, let's be honest, hedge funds disguised as foundations
Yeah.
and
Pension.
other kind of correct. Yeah. But yeah. So but basically to me, one of the differences in a very colloquial way, it would be that you have a full-time asset manager or investment manager whose 100% job is to understand what's happening in the markets and to evaluate these investments. And the retail investor, I would think of as somebody who spends less than 50% of their time on the investing side of their work, right? So they don't have a kind of institutional manager. This is not everything that they think about. This is kind of a part of a portfolio of ideas. So as a business person, I am absolutely considered a retail investor. Investing is not 100% or even 50% of my time. It is something that I do, but I even in the private markets as well as public markets would be considered a retail investor. What about you, Namaan?
Same. Same. I manage my own portfolio. I maybe spend a handful of hours a year thinking about it. So I'm definitely a retail investor.
Love it. And so when I was looking at the retail revolution, my first question was, are we talking about alternative assets for the retail space? Because retail is a very interesting space that has a unique play of credit in it. So there are credit products for the physical retail space, not the investment retail space, that are very different than in other places. They're often, they're often collateralized against real estate or inventory. Sometimes they're in risky plays on cash flows, but there are unique brand propositions. We talked about this with Claire's and Lids before. And so that was my first thought when I read this article, is that they're capitalizing on the retail revolution and that they're building their credit portfolio. But as we go through this, it's actually not that. And I think there's a very interesting narrative here that tells you something, whether you want to build a fund, which, by the way, just super personal harp. When I was in business school, I felt like the number one thing that every top business school in America should have had each one of us do was build a fund. I like every single one of us at some point in our life have needed to build a fund, will need to build a fund. The ones that do it earlier, build them bigger and better. Like fund building is a natural part of capital management that is absolutely valuable. And I felt like it was a huge miss. We talked about big fund managers in the same way that you would like sit in a business class and talk about Google 40 years after Google, was founded. And then you're sitting there thinking like, gosh, I really wish that we could replicate this kind of behavior in people. And so I feel like that's the number one thing. So if you're listening to this and you're in business school right now, start a $100,000 fund and raise money into it and buy one rental property in some kind of location that you're going to Airbnb. Like, make it simple, but get the fundraising portion of your life over as early as you possibly can. Because when you have access to capital, as you're going to see in this article today, you have so much opportunity that you were restricted by simply by your own debt or your own credit profiles. And so if I could give like one piece of advice to today's business students, it would be that: raise a fund while you're there. But anyhow, Namaan, these are a couple of the kind of key highlights, and I just want to poke on one or two questions for you. The first one is that they're seeing better than expected momentum among individual wealthy investors. So quickly, why? Why do you think this is? Hypothesize before we dive into the article.
Yeah, my hypothesis is simple, that individual wealthy investors feel like they can get better returns in the private markets than they can in the public markets. And the private markets have not been accessible really to individual investors up until very recently. So it's the new shiny sexy toy. And so there's not just the allure of higher returns, there's also some of the prestige that goes along with being involved in the private markets that I think is luring individual wealthy investors in. And I understand it. If 80% of your equity portfolio is in the public markets, you can afford to take 10 or 20% off the table and go after what many would consider to be higher risk, higher reward opportunities in the private markets.
Namaan, what do you think those return profiles would have to look like right now? I think that just to push back on you. And by the way, the article kind of shares there's actually another reason other than the one you mentioned. I would never have guessed it, so I'm really excited to talk about it as we get to it. But the like one of the challenges that I think that I would have with that beginning point is just that the returns have been exceptional in public markets, and the risk has been actually pretty low also in those public markets. And there are certainly companies that are probably overvalued in public markets, but like some of them are tariff hedged. So that overvalue is not reflected because of tariff risk, which we've talked about before. Others of them are probably undervalued based on some of the potential strategic value that they might have. I would think of Apple and its cloud suite as one of those examples of being like a very highly valued company that potentially is still undervalued. So what do the return profiles have to look like to beat what we've been seeing in public markets?
Great question. And I'm projecting here because this is not my own feeling, right? But I'm projecting.
And you already told us you're a retail investor. You're a market outsider, right?
Yeah. So here's like my 2 to 3 reasons why people might be feeling like this. Number one, we're on a crazy 15-year bull run in the public markets. Like take the COVID dip out, extenuating circumstance. Take 2022 out. 20% drop, that's fine. But like in the midst of like a crazy 15-year bull run, I think the feeling, especially among individual retail investors is like, how long can this gravy train last? Yeah. Right? Like there has to be a bear market coming soon, I think is the feeling amongst like a subset of retail investors. And so I think you see people turning to the private markets because they're looking to get ahead of what they feel like is a correction that's coming. And part of that is because of just the inflated valuations that we see, right? Like you're seeing, the S&P trading at higher multiples than it's ever traded at before. And we could argue all day until the cows come home on whether that's fair valuation or not. But the truth is that people feel like the public markets are overvalued, right? And my feeling's a little bit different, but that doesn't matter. Like people make decisions based on how they feel about the market, not based on logic, facts, and data. And so
especially retail investors, but even institutional, I would argue.
Even institutional, exactly. Right? It's human beings making the decisions. Unless you're like a purely like algorithmic driven firm, like emotion plays a part in the decisions that you make, especially because you are serving end clients who are expecting a certain rate of return every year. And so if you're an institutional investor, like you have a shorter time horizon. And so if you're not just driven, your decisions aren't just driven by the fact that you have shorter time horizons, but by the fact that you have very like demanding clients who expect short-term gain. And so of course emotion plays a role in your decisions as well because of the reality that you find yourself in. Now going back to retail investors. So I think number one is, okay, the question that they're asking is how long can this bull market run last? I think the second question that people ask is how can I outperform the market? Because performing at par with the market for a lot of people just isn't enough. They're looking for alpha. And so where can you go find alpha? Well, one of the places you think you can find it is the private markets. And then number three, to be honest with you, I think some people just get bored. Right? They're like, okay, like I feel like I know the public markets. I know these companies. I want investments in earlier stage companies. I want to feel like
teach me something,
that
right?
teach me something, or I want to feel like I'm part of the next wave of technology. And so like most of the like budding AI ecosystem right now, those companies are not publicly traded. Like they're available to you only in the private market. So if you feel like you want to be involved in that, there's really only one place that you can go. And then the fourth thing that I'll just say that I think is a big driver of this is the explosion of private credit. And so you're seeing these private credit firms, these private equity firms really step into like the role of a bank here and begin to lend more freely than some banks can lend because they are subject to different liquidity and regulatory constraints as opposed to like traditional banks. And you are seeing like private credit explode. You are seeing, firms out there. I can't verify this, but I've heard firms out there guaranteeing like almost risk-free 12% returns, like in private credit portfolios. I think when people hear that, that's attractive. And so there's all of those reasons and more why I think people are getting drawn to the private markets. And the fifth reason is just accessibility. Like you are seeing relationships take place between kind of brokerages and advisory firms and like the platforms that retail investors use that are giving them access to private market products in a way that we've just never had access to them before. So you combine accessibility with all the other reasons I mentioned, and I think it makes sense why you're seeing some of this momentum.
I love it.
Do your projects ever drag? Budgets creep? Deadlines slip? Or worse, do you deliver something that meets the spec, but no one's happy with how it got done? If that sounds familiar, it's time for Management Consulted's project management training. Our program brings consulting level rigor. These are the same tools and approaches that top consulting firms use in a format you can deploy across your team now. You'll learn how to build battle-tested project plans, anticipate and manage risk, align stakeholders early so surprises are minimized, track progress transparently, and hit those milestones without burning out resources. Each training includes tailored project templates, real case studies, and live feedback. No fluff, all impact. If you lead teams, work cross-functionally, or just want fewer late nights chasing deliverables, this is for you. Head to managementconsulted.com/project-management-training. That's managementconsulted.com/project-management-training to invest in a program that will save your team time, money, and heartache.
I think you're right on with so many of those. In fact, this week, Namaan, I got a phone call that I've never gotten before. We've owned our winery for 18 months now. And it was from a guy that I think was probably not a robot, who said, hey, like we've done some, vineyard lending deals. If you want to refinance your credit on the vineyard, we just did one at 5.5%. And obviously like that's a very specific, incredibly low number that I was thinking like, wow, the only way you make an excessive market return on that is if you're actually counting on the vineyard closing and you're going to take the assets, right, at some like discount of value, because 5.5% is really hard to beat market. But I'm totally going to call the guy back because it was a private market lender. And vineyards are not super easy to get public market money for in the first place. Usually I would expect to see a much higher rate than that. It was an interesting starting point. And so just to your point, like not only is there the availability of private credit, but there's also people are hunting credit deals in a way that we haven't seen that before on products like vineyards, super specific, where developing kind of a niche understanding actually might give you the ability to generate some alpha in different ways. And so yeah, I had like literally that experience just this week. So let's talk a little bit about that. I thought this is also just a little bit, if you don't know who Ares is, 10 offices globally who work on product development. You mentioned product development for retail investors. So I would, and especially for financial advisors earlier, I would love to know if that's what they're talking about. And then also client education. Product development can literally also in a fund mean like I'm looking for assets to invest in, right? So I'm looking for assets to invest in and then ways to fractionalize those assets. So I'm not just looking at the asset side, but I'm looking at the way that the size of an asset that different people would want to take, the way that we will actually manage the deal flow, the subscription process, in some cases, funds will run like a competitive application process for deals so that they can see which kind of deals are of interest to their audience. And then there's also this kind of narrative, which I think is going to be important for us to address too, that weaker products are being reserved for retail. So the idea is basically like we have a ton of deal flow. A lot of our really good deal flow is going to go to our institutional investors who are going to kick the tires and dig under the surface, and they're going to care about a specific profile of return. And weaker products, by the way, could be either higher risk or like lower security, so not as collateralized. A lender or a borrower or a business that you've never worked with before, right? So it could be like a risk profile issue. It could be a size issue too. So weaker products could be like, hey, like an institutional investor. I've experienced this, by the way. Like I play in real estate in a market where institutional investors don't play. They don't play because there's not enough ability to deploy capital in my market. That's one of my advantages there, is that we're in a market that's small enough that there is no institutional capital. But when you move down market like this, you can sometimes play in those markets. Sometimes they're better. sometimes they're worse, right? There's sometimes a reason why the institutional capital didn't go in. So he's kind of addressing this thesis that like it's possible that you're giving crumbs or problematic deals to the lower end of the market. Of course, he's going to say that they don't. Let's try to figure out why.
Can I just quickly?
Yeah, I was going to say, do you want to address either of those?
Yeah. So I want to dive in quickly, right? And obviously, Ares is an alternative asset manager, so I just wanted to make that really clear, right, to everyone listening. But the question that I have, and that I'm going to try and answer here very, very quickly, is okay. We've talked about why retail investors would be interested in the private markets, but why are the private markets interested in retail investors? Because that's a good question. That's new, right? Like for decades, private markets have ignored retail investors, and the short answer, like as to why, is because they haven't needed them. And now what you're seeing is that institutional investors are oversubscribed. Like the money is running out, and these alternative asset firms, these private equity firms need additional liquidity, right? So that their institutional investors can cash out. And so, like, where do you turn? Like, the biggest pot of capital and liquidity that's left now is in the retail bucket. And so this isn't like, don't believe the bullshit about like democratizing access to the private markets. Like, that's what you're going to hear all these people say, right? Like, we are doing a public service here. It's like, no, they need and they want your money. Right? Like that's what it comes down to, right? And so like the reason that they're going after retail investors now is because they need you, right? And so and what I've just mentioned is the big reason why they need you. And so this isn't like by accident that it's happening now. And it isn't by accident that you hear right now kind of talk in Washington, talk on Wall Street about like being able to invest part of your 401k in private assets. Right? Yes. Like that is the biggest pot of money available to these firms, like trillions and trillions of dollars. Most Americans have like their 401k contribution set on autopilot. And so it's not just a big pot of money today, it's a pot of money that's going to grow into the future. And so that is like the white whale for these firms, which is why you hear a lot of talk, like if you're kind of plugged into what's happening on Capitol Hill, if you're plugged into what's happening on Wall Street, and if you're not, that's part of the reason you listen to this podcast. But you hear a lot of talk right now about these funds and these alternative asset options getting access to our 401ks. This is why they need the capital. And those 401ks are the biggest pot of capital available right now in investing.
And one of the challenges on the firm side, they have this 185 people that are working on product development and client education, is that they can't blow out their costs serving retail. So the reason they didn't do it before is that until they absolutely needed you, of course, you'd rather manage 10 really large institutional investors because it's not expensive to manage them. And you don't have like grandma crying because the share of something dipped 10%, or you're dealing with like a bankruptcy sale and you have to go through a long legal process with it, right? Like the institutional investors understand. They're incredibly reachable, and there's a very small number of them. And in the 80-20 rule, like they were always the 80. Right? They were always the 80. And so if you can go after 80 and leave the 20 behind, that is 80% of the work for 20% of the return, like you're going to leave it. But they're in the 20 now. That's basically what you're saying, Namaan, right? They're in the 20% of the amounts. And what we're saying, though, is that potentially it's a larger amount than that, but it's definitely more work on a per investment
more work
basis.
Unless you can reach them through some of these platforms like Vanguard, Schwab, Robinhood, right? Like who already own those customer relationships and can get you retail at scale. I think that's the
So you're just
here.
Developing this as a product that they buy into. You're getting the liquidity. You're helping to manage them in a different way than you've managed your institutional investors before. So this is kind of one of the leads that I thought was super interesting, right? So at their analyst day last month, they quietly bumped their 3-year fundraising targets by 25%. Part of that is that they can. So they recognize this as a source of capital. Part of that is deal flow. So this says something about deal flow in the market, and it could mean that the deals are simply larger. Right? If the deals are larger by 25%, i.e. they're either more competitive, or the deals that are coming to the table are larger deals, you're going to need more money in order to complete them. It's also possible that they have more deals, right? So there are a larger volume of deals, and it's thirdly possible that it's some combination of both, right? But one of the reasons that funds grew in the last decade was not because of the number of deals, but it was because the size of the deals got bigger and bigger, and every deal that somebody would even want to or have to participate in was challenged, oversubscribed, and very, very large. But this, he said, right, the change was due to better than expected momentum among individual wealthy investors. And, I thought this was interesting, Namaan, right? They said that this recent survey by State Street said that the retail revolution, which is what we're talking about now, the idea of basically being able to deploy your personal capital in different ways than you have before, by engaging with these alternative assets, will drive more than half of the private market flows. So we're talking about 80-20 earlier. This is saying like we're talking 50-50. So again, are institutional investors still the ones that people want? Yes. Out of that group, they still are the ones that people want, because that retail 50% of the pot is still comprised of a ton of smaller players. But like you mentioned earlier, the size of this is too large for them to ignore. The other thing that I just want to talk a little bit about is I want to kind of, bump down here. And again, we'll link to this article so you can read it. The narrative of the weaker products, I don't think is that issue. But this one, this chart right here, I thought was super interesting. Namaan, we're in a case interview. Give me a quick read on what you're seeing in this chart.
Well, I'm seeing 5 categories in the chart. I'll walk you through them, in order from largest to smallest. The biggest kind of part of the overall pie here is credit. So 66% of Ares' portfolio is private credit. We've already talked about that.
I thought that was fascinating.
And then you've got 23%, so about 4/5 of their portfolio is either private credit or real assets, which I would assume to mean real estate or some kind of physical asset. And then
real estate, or it could be like big, furniture, equipment, like something collateralized. Though.
Something collateralized. And then like the remaining 10th of their portfolio is, the secondary markets, private equity, and then like other alternative assets. And so you can see here that the biggest driver of growth for this firm is actually private credit. And I would expect that to continue just based on what we've talked about so far.
Yeah. Absolutely. And so who knows? It could have been an Aries guy that was calling me about the vineyard, right? But I would not have expected credit to be the largest portion of this portfolio, at least not by that size. So that's super interesting, right? Recognizing in a period of rising rates, to pursue private credit, sometimes you're going to get crunched a little bit, but access to capital is something that's always necessary in the market. So that's really interesting.
2 things quickly, very quickly. I think if I was one of these firms, what I'd be concerned about is like the big financial institutions stepping in here. So there's no way that JP Morgan's going to see this and not step into private credit. I mean, they already are, but they haven't really invested in it so far. And so like, I think you're going to see competition in this kind of
down market
competition, down market competition increase. And I think one of the things as an investor you have to be wary of, or at least aware of, is just that these alternative assets are less liquid than what you find in the public markets. And so like your opportunity to exit is different and less. And so you just have to be aware of that as you're putting a portfolio together.
Well, that has been true, Namaan, but that's actually one point of interest
that's something they're trying to change.
If you have 10 institutional investors, in order to make it liquid, you have to pass the buck to another investor, and you also have to strike the value at the point when you would potentially do that. And just like running my first fund right now, it's a small fund, but that was one of our biggest challenges we had to work through. What if somebody wants out? Well, how do you value it? That valuation process actually costs a lot, takes a long time, because you're not at a natural deal point where people can either choose to like reinvest or exit, right?
What I think a more interesting reading of this chart would be, or a secondary chart I would put together, is now lumping these 5 categories into liquid versus non-liquid assets. And I think that would give you like a better view of like what Ares' like value proposition is to retail investors, right? Because I would put credit in the liquid category, and then I'd put private equity in the non-liquid category. Correct. And that would be like a more interesting way to, I think, break down their portfolio.
And you can imagine in productization, like that, I could say, hey, Namaan, give me $100,000 and I'll pay you 8%. And if you want out, you can have out, because the only thing that's required for that is that I have to have another $100,000 waiting for me. It's pretty easy to value. The value is assumed to not be the appreciation or the depreciation of the credit. The value is largely assumed to be the cash flows of the credit. So as you're mentioning, I think that makes a lot of sense. There are obviously credit portfolios that don't think think like that. Like I was mentioning earlier, how do you beat, with 5.5% returns, how do you beat market? You have to assume that there's going to be some assumption of assets in the credit process. And that's a little bit more challenging to value. But if you've never taken a credit class, by the way, I think that was one of the very best, hardest, and most insightful classes that I took when I was at Columbia. And I would highly, highly recommend that you take one. But this is what I really wanted to get to, Namaan, because you mentioned earlier, like the reasons, right? Why would the investors be interested in this?
Diversification
this is the one
is what
that
I did mention.
I wouldn't have expected it, actually. But it's becoming super true and super interesting right now. And like the US is the largest, most diversified financial public market in the world. But basically what they're saying is that like if you were in London in 1980, you would have invested in private assets in part because the consolidation of assets in the market was not sufficient to provide diversification for you. And we kind of felt like for a season, we came on the outside of that. But then the centralization of valuation in just a few huge stocks in the US market is basically creating diversification risk, right? And so we have still the largest market. It is still very, very diversified, but that diversification doesn't mean much if 50% of the market is in 5 to 10 stocks, right?
There's the S&P 7 and then there's the S&P 493.
Yeah.
And you have 7 stocks that are driving like a majority of the market capitalization. So you're right. Like, is the S&P 500 still a diversified fund? Yes. Is it less diversified than it's been in the past? Depends on the time period you're comparing it to. But yes, right. Like there is some diversification risk now that probably didn't exist 10 years ago.
There are still a lot of stocks in there, but if you think about supplier risk as being a key risk for businesses, okay, well, I have one supplier. Or if you think about customer risk as being a big challenge for businesses, I have 50% of my product is sold at Walmart, and if they change who I sell to, then that makes a big impact on my business. That sense of fragmentation is usually healthy for an operating business. It's healthy for a market as well. And that's basically what they're saying is one of the driving factors. He's not saying all the other things that you were saying before. Look, you don't diversify for lower returns only, right? So you're not like, oh, look, I'll take a 1% return instead of a 15% return for diversification purposes. Otherwise, you could just diversify into cash at any period in time, and you could always be more diverse. So that's it still has to meet a return profile, and certainly some of it, I think the vanity aspects are important that you mentioned earlier as well. But that diversification play was one that I didn't think of at the beginning. And I think it's important for people to note that if there's a driver in the market, you have to like I had to go 4 pages down in this article to find what I felt like was incredibly insightful about what's happening in markets right now.
I think the definition of diversification is that you have non-correlated assets in your portfolio. And so what that means is that like that when one asset is up, the other one is down. Like that's how diversification works, and then vice versa. I think the jury is still out on like if like the private markets overall are actually non-correlated with what's happening in the public markets. Because
exactly.
I would argue that like macroeconomic conditions and the ability of like US companies to continue to expand margins is what drives like public return. And so like I don't know how that's much different than what would be happening in the private markets. And so I'm sure data out there exists. I'll look for it, but I'm not like convinced that these are like non-correlating assets, at least at the base level.
Well, and I think that the idea of diversification and the math of diversification are different, right, Namaan? Because like you said, right, true diversification would be that 50% of your portfolio is up while the other 50% is down. And most people don't play that way. They play like a 20% hedge at the most. And then they also don't really play for the downside risk. They don't play to capitalize in the downside. They play to preserve in the downside. And that's a hugely different correlation measurement than if you're literally just trying to be, completely risk hedged to maintain the same average rate of return. And why? Because like in a 15-year bull market, you can't keep raising money if you were if you were 50% under what everybody else who was following the market was able to accomplish during that time.
That's why it's very difficult for me to compare fund managers against each other. It's very difficult for me to compare like my portfolio against somebody else's, because like the X factor is always your time horizon. And your time horizon is going to determine the decisions that you make. And so it's almost never an apples to apples comparison.
It's so true. It's so true. So if y'all are early in the process, I think there are a couple of key takeaways from the conversation today that we want to leave you with. First of all, pay attention to what's happening in private markets. That was actually part of the premise of why 6 months ago we started this podcast, because we believe that the insights from the non-market based companies are worth investigating and understanding, and the broader economy is so much bigger than what public markets are reflecting, that it's essential to understand what happens there. There's money to be made there. There's insight to be had there. That's where a lot of the work is being done for consulting firms. We're seeing consolidation for firms that are working for groups just like Ares. And so, understanding it from a consulting or from a business or investing perspective is, I think, essential. But also, we would really encourage you to get more actively involved. Don't just be a bystander here. Like, go find one of these funds and do the research as if you are thinking about actually investing in them. Think about one that's fractionalized. If you'd feel more comfortable with that, do a direct deal if you're able to, and then start thinking about raising a fund to do something that's pretty, that's pretty reasonable. Like, find a credit lender, right? If credit is such a big part of this portfolio, I bet you can find a business that you think is a pretty decent business that would take $100,000 off of your plate. Like, become a credit lender at $100,000. If you can do it once at $100,000, you can do it at $100 million. The scaling is actually not that huge, but that first learning of building a fund to buy your first real asset in real estate, or do your first credit deal, is going to be a massive learning for you. And we are excited to hear your stories of how that happens. So if you've got places to weigh in, we only looked at one company today, Ares Management. Go look at others in the space. They don't always report like this one does because they're private. But when you have, analyst days or investor days, or when they do have a public component and you're able to kind of get under the hood, go figure those out. You're going to understand a lot about what's happening in the U.S. economy and business at large if you do that. Any final takeaways from you, Namaan?
No, I think that was a great wrap up.
All right. Well, if you haven't already subscribed, come on, let's do it. Stick around. Bring us on your runs. Take us wherever you go. And we love to be a part of that journey. And then please, if you have a great idea for a future pod, just like this one came up because of conversations in private markets, bring it to us. Send us an email, team@managementconsulted.com, and we'll see you on the next episode of Market Outsiders.